Welcome to today's Explainer. The software industry as we know it is being completely rewritten right now as we look toward 2026. The old playbooks are literally burning, and we are staring down a fundamentally different and honestly far more ruthless landscape than we had just a few short years ago. Okay, so let's dive right into this by asking the really hard question, the one on quite literally every founder and investor's mind right now. Is the software as a service industry facing an actual existential crisis? To answer that, you really just need to look at the median customer acquisition cost. It has surged to a completely staggering $1,200 per customer. I mean, with ad costs absolutely skyrocketing across platforms like Google and LinkedIn, it has simply never been more expensive to win over a single new buyer. So, the crucial takeaway here is that the old playbook is just completely broken. The whole era of growth at all costs, it's dead, done. Smarter, much more efficient growth is, quite literally, the only viable way forward for software companies today. Section 1. The growth era is dead. We are seeing a massive contraction right now in the market. SaaS company formation, if we use seed rounds as a proxy for that, has plummeted by 44% over the last 3 years. The barrier to entry to actually raise capital has gone up so dramatically. It is simply way too expensive to operate inefficiently anymore. As SaaS Mag recently pointed out, the median company now spends $2 just to acquire $1 of new annual recurring revenue. That is literally like buying a dollar bill for $2. You just can't run those numbers and expect your business to survive the long game. Section 2. Capital efficiency and benchmarks. We're seeing a completely new baseline for sustainable growth. One that totally moves away from sheer volume to a laser focus on unit economics. To actually be healthy in 2026, your gross margin needs to be comfortably above 75%. Your SaaS magic number, which measures sales efficiency, well, that must break 0.75. And your net revenue retention, it absolutely has to exceed 101%. If you slip into the red flag column on any of these, you are going to instantly scare off investors. There's also this massive efficiency gap between funding models right now. Venture-backed companies are still burning so much cash on sales and marketing, sitting at about 47% of revenue, while their private equity-backed peers are running so much leaner, allocating just 33%. But financial metrics are really only half the story here. Section 3. The AI architecture reset. Research Affiliates breaks down the AI threat into 3 really distinct timelines. Today, we've got cyclical C compression. Basically, AI makes workers faster, so companies just buy fewer software licenses. Tomorrow, there's a secular risk. Agentic AI actually displaces the business logic of software entirely. And over the next decade, we're looking at a super secular shift, where AI agents, not human beings, become the primary users of enterprise software. It's wild to think about. Because AI workloads heavily amplify existing system weaknesses, the fastest-moving companies aren't just, slapping on a new chat feature. They are fundamentally rebuilding their core infrastructure. They're prioritizing monolith to modular refactors, event-driven architectures, and massive investments in observability. Infrastructure is absolutely no longer just invisible background work. Section 4. The rise of vibe coding. We really have to ask ourselves a very serious strategic question here. What happens to traditional software moats when absolutely anyone can build a functioning app just by describing it out loud? Well, this is exactly what vibe coding is. It's an AI-driven method that completely eliminates the need for expensive developers. Founders are using AI to generate code, interfaces, and logic simply through natural language. And that speeds up their time to market by 3 to 5 times. Thanks to vibe coding totally democratizing software creation, it's projected that there will be an incredible 25 to 30 million solopreneurs in the US by 2026. These solo founders are leveraging AI to spin up micro SaaS competitors literally overnight, without a traditional engineering team in sight. So how on earth do established companies survive this immense pressure? Section 5. Vertical SaaS Keeksover. The answer is deep specialization. The market is showing us right now that vertical SaaS platforms, meaning tools built for highly specific industries, are currently commanding a massive 25 to 30% valuation premium over broad, horizontal platforms. And vertical vendors aren't just waiting around to be disrupted. They are executing a highly targeted 3-step M&A playbook. They acquire adjacent niche tools and then integrate them into one unified platform. And let me tell you, this integration step is absolutely make or break. Get it wrong, which a shocking number of these acquisitions do, and the entire deal completely falls apart, destroying immense value. But if done right, it vastly increases switching costs. Because once an industry relies on an all-in-one suite, it is incredibly hard for them to ever leave. Because honestly, none of this matters if you can't keep the customers you actually have. Section 6, the new rules of retention. Top performers today must push their overall monthly churn below 2%. And if you're in the enterprise sector, the expectations are even more brutal. You need to keep churn between 0.5 and 1%. To hit these numbers, companies absolutely have to eliminate user experience friction and solve those massive integration nightmares that always drive buyers away. And to actually hit those retention goals, we're seeing a huge pricing shift. Companies are abandoning outdated per-seat pricing, which, let's be real, actively punishes growth and limits widespread adoption, in favor of outcome-based models. In these new models, value is directly tied to results. Customers want to pay only when the software and the AI inside of it actually delivers real value. So I'll leave you with this final thought to assess your own business today. If your software can be replicated by an AI prompt tomorrow, what is truly keeping your customers from leaving? In 2026, it all comes down to the depth of your data moat and your workflow lock-in. Thank you so much for joining me for this explainer. I really hope this brought some serious clarity to the changing market, and I will catch you on the next one.